Chapter 5. Price and Value. The stock market is filled with individuals who know the price of everything, but the value of nothing. Philip Fisher. Warren Buffett famously said, "Price is what you pay and value is what you get." You better count what you get. Your focus should always be on value because the value is what you are getting, and this is what you will be living with. You must make sure that what you receive is worth more than what you pay. Market prices only matter at 2 points of time in the investment life cycle. First, when you buy, and second, when you sell. In between these 2 points, value matters. Multiplying your holdings with prevailing market prices and reflecting on this is a loser's game. Don't do it. It doesn't matter what the current market price is until you want to either buy or sell. So please ignore it for your own good. Using price as a decision to buy. I am not suggesting that you should not be using the price at all to buy an investment. Of course, you should use price as a guide to maximizing the potential of your investment. However, the basis of your investment decision should always be the valuation of the asset. Once you are comfortable with the investment's growth and safety, you wait for the right price. Believe me, no stock will run away from you. Even if it does, there will be thousands of other opportunities. In the short term, market noise may push a stock to unsustainable levels, but eventually, it will come back to a reasonable level where a prudent investor will be willing to buy. Fallible, emotional people determine price. Cold, hard cash determines value. Christopher C. Davis. If you decide to buy a stock solely based on price action, you cannot and will never have any faith in the company's business. If your bull case to buy a stock is a sharp price drop, or prices going to the moon, you don't have a bull case. Imagine you bought a stock because it was cheap, which was the only reason you bought it. It was about 50% down from the all-time high price. What if the price goes down substantially from your purchase price? You will be kicking yourself and looking for an exit point. On the very first opportunity, you will sell your shares, probably on your break-even point, just to watch it go substantially above your selling price. It happens to all of us. The second most common reason people purchase a stock is when a share makes a substantial run. Everybody you know is buying the stock, and you are watching from the sideline. Eventually, one good morning you give up and buy the shares. For a couple of weeks, everything was looking good, and you have a few percentages point gain. On one weekend, bad news arrives, and the stock goes down significantly. Now you are in the red. You waited a couple of weeks, but stock keeps going down. On earning day, you are hoping for good news, but the exact opposite happened to your shock. The company reduced its future guidance and the stock tumbled badly. Now comes the analyst community, who is cheering up the stock while it was going up. Now one by one they are downgrading it. Before you know, it is down substantially and the pain keeps getting worse. You decide to stop loss just below the next support line and promise yourself that you would not move your stop loss further down. One day, when the whole market was in red, your stock reached that level, and your holdings were sold. You eventually have closure and promise yourself not to buy the same stock or anything in this industry ever again. The market kept going down for another couple of weeks, but ultimately changed the course. Your stock recovered in a few months, not to the level where you bought, but substantially above your selling price. Almost everybody who has done some trading, swing or day, will agree that knowing when to sell is much harder than knowing when to buy. You never know what the best time to sell is. I am sure it must have happened to many of you. That stock kept going up after realizing your tiny profit. Once I bought a company at 151 and happily sold at 183. Fast forward a few months and the stock was on 400. Another stock I bought at 970 and it started fluctuating between 930 and 1,000. I kept the stock for a few months, and on one earning day, the stock broke 1,000. In a few days, it reached 1,250, and I happily sold it just to watch the stock reaching 1,600 in a couple of more weeks, and 2,000 in a couple of months. These bad experiences don't happen all the time, but these happen now and then and are enough to dent your yield close to the market average or lower. Most of the time, traders get above average returns, but when a portion of your money is sitting idle, or losses on unsuccessful trades plus trading cost averages out everything. Not every trader makes a below average return. Few traders make huge returns, but when millions and millions of people are trading, some people will make substantially more than average. It is just the laws of statistics. I am sure some people are very skilled and trading comes easy for them, but it is a game of chance for most of us. Let me share with you a personal experience. When I started investing in stocks, I used to buy solely on price action and stare at the screen all day long. The worst experience in my early investment days was purchasing stock in a large biopharma company. The stock was oscillating between 105 and 108 every couple of days. 23 analysts out of 24 had strong buy ratings, and one lone analyst had a buy rating. I got excited and bought the shares worth about 10% of investment capital. My purchase price was about 105. I sold the shares at 108. The second time when it came back to 105, I bought about 30% of my capital, sold again at 108, and was waiting for it to go back to 105. I repurchased it at 105, and this time 100% of my capital. I sold again at 108. I repurchased with 100% of my money at 105, but this time, stock went down to 103, and then to 100. For a month, it was jumping back and forth between 100 and 103, and suddenly one day went down to 97. At this point, I was anxious because my whole capital was in one stock, and I was having a restless sleep. After a few days, I sold the shares at 102. The same share went down to 85 in a few weeks, and I got greedy and bought some shares with 100% of my capital. I was determined to recover my losses, but to my horror, the stock went down to 75. One night, and I am not making this up, I dreamt that I was washing all of my capital in the form of dollar bills in the kitchen sink, and money was going down the drain. When I woke up, I put a sell order on the market and closed the computer. My stock was sold at about 80. I lost about 10% of my capital. I did not buy another share for the next 6 months, and to this day, I haven't touched any other biopharma company or biopharma ETF. Although it doesn't matter, just for curious minds, that stock went up to 134 in a couple of months, and then sharply dropped to about 50, and then never recovered. The last time I checked, it was around 65 for a couple of years. What were my mistakes? You can see I made almost every mistake that all new investors should avoid. 1. I knew nothing about medicine, let alone the biopharma business. To this day, biopharma is an alien world to me. 2. My entire market research was that 23 analysts out of 24 rated this stock as a strong buy. I did not bother to read any financial information, expected cash flows, or competition. I did nothing, even though I was holding only one security. Even during the period when I was holding this stock, I did not do any market research, not even reading analyst reports that were available for free on my broker's website. At most, I was reading news about this company. 3. I was focused on price action and thought this was free money. Buy at 105 and sell at 108 and keep doing it. 4. I invested 100% of my capital into one stock. 5. I had no plan, no risk management. Basically, I had no idea about the investment business. For the next few months, when I was not doing any trading, I started reading about trading and started learning about different aspects of this business. First, I learned about swing trading because I hoped to get rich quickly by doing swing trading. I learned about technical analysis and day trading. My early days reading mainly consisted of price action analysis, day trading, and swing trading. I used to make different plans and strategies to beat the market and pick different tops and bottoms. I was looking for a holy grail of stock investment. I eventually found it, but to my surprise, it was not a trading strategy, but a small book by the great John Bogle, The Little Book of Common Sense Investing. The problem with using price as your basis of buying decisions is that all of your future decisions will be based on price. There will be no other factor as important as market price. Every tick down in the market will look like a personal loss to you, rather than an opportunity. If you have a significant position solely based on price, it will affect your thinking, sleep, and decisions. You feel good and bad with a penny up and penny down in market prices. You will never realize that a penny up or down is only one shareholder's decision among millions, and market prices have nothing to do with the company's actual business. Keep your focus on value and business. A share is not a lottery ticket. It's part ownership of a business. Peter Lynch. An investor should understand that stocks are not quotes. They are proportionate ownership of a business. Your focus must be on the company, not on the price. Market quotes change every second, but business evolves steadily. You have ample time to evaluate a business, to buy or not to buy. There is no rush. You could have bought Amazon at the peak of the dot-com bubble and paid $100 per share, or you can buy the same share 3 years later at $5 a share. The difference is 20 times more money in your pocket. An investor should be completely detached from the day-to-day price action. Last transaction price cannot and should not be a tool to measure the success or failure of investing. Always have a bull case in writing. Know what you own and know why you own it. Peter Lynch. Before investing in any asset, and particularly in stocks, you must have a bull case. It is advisable to write down all of your reasons. After a quarter or two, look at the list of reasons and re-evaluate, especially whenever you have an urge to sell. You should only sell when most of your reasons are no longer valid. For example, you bought Sears because it was the largest retailer in the US. As soon as Walmart took the crown, this reason was no longer valid. Try to write your reasons in objective terms as much as possible. It is easier to evaluate if your reasons are expressed in numbers. However, there will be qualitative aspects of a business, and they can be crucial. It is not obligatory to assign a number to every reason. You can write your reasonings in subjective terms if it makes more sense. Think about the person on the other side of the transaction. For every sale, there is a buyer, and for every buyer, there is a seller. There is another person on the other side of every transaction. Always think about the person on the other side. Try to make a case for the opposite of your trade each time. If you are buying, try to analyze why somebody is selling to you. And when you are selling, try to evaluate why somebody is still buying. In a two-party transaction, you have only a 50% chance of being right, at best, if we can count only luck. Have you ever played chess with yourself? Try it. It is super hard to play a game of chess from both sides. Thinking about the other side of the transaction is like that. It is hard and challenging to pull off, but your understanding of the business and market will be on another level when you force yourself to do it. Only time will tell which side of the transaction is right. However, investors who do it routinely develop a superior understanding of the market and are less likely to engage in impulsive transactions. Chapter Takeaways. Market price matters at only 2 points in time, when you buy and when you sell. In between, it is only a distraction. Detach yourself from day-to-day price action. As an investor, your primary focus should always be the business. If your initial decision to buy is based on market price, all of your subsequent decisions will be based on price. Always write down all the reasons why you are buying an asset. Review the list periodically and only sell when the majority of reasons are not valid anymore. Before pulling the trigger, think about the reasoning of the person on the other side of the transaction.